All right, let's get going here. Starting a couple minutes late for one reason, and that is let's take this to the side. U.S. official phase one U.S. China agreement may not, read down here, be signed at the APEC meeting in Chile, but does not mean talks have fallen apart. Just more time is needed. So, what happened? They broke them from around 41 down to 34. 41 will be overhead resistance, again, in my opinion. But that's where not this break came from before we closed the trading. And this break in here was this headline right before the top of the hour. So a little nugget of why it's important to follow and be privy to not only what's driving the market, but what comes across the wire. Wait 1 second. Um, not only to know what's driving the market, but know if something comes across the wire. There is no thinking. That was bearish news, period. Because what's baked in is they got this thing signed. What do you mean you're not going to sign it? I thought you guys agreed to it, is what the market's saying. I thought this would be a perfect opportunity. You get both leaders to sign it. There must be some hangup. That's all political talk. This market's going to drift lower. I think this is bearish enough. I mean, yeah, they put they tried to put a pretty bow on it to say everything's progressing fine. But I want also people to recognize what's next in the line of these comments. What's next? Someone higher up than whoever came out to say that says, no, they're going to still plan on signing it at the APEC meeting. That's a possibility. So keep your antenna up for that. But for today's session, and it's not going to be a long one, it's just to go over the FOMC for tomorrow. In case you're living under a rock, the Federal Reserve meets yesterday, or they commence today, and they finish up their meeting tomorrow with a statement at 1 p.m. Central. So I'm not going to take anything for granted right now. I'm going to make sure everybody's on board with this. At 1 p.m. Central, they release their statement. At 1:30 Central, which has market moving impact, they have the press conference with Powell. 1 Central statement, 1:30 Central, the press conference with Powell. So that's the first part of the preview, is knowing what time this stuff's supposed to come out. The second thing is, and I tell people all the time, that if you don't have this link bookmarked, you're crazy, and you should have it in a tab that's open on your browser. But it's this guy right in here to go over the percentage chance and probability that they're going to cut rates or not. They're up to 97.3, 24 hours ahead. That's the highest that they've been percentage-wise, and the likelihood they're going to cut a quarter tomorrow. How do I know it's a quarter? Because they're at 175.2 right now, and 150, 175 is a quarter lower, and there's 97% chance that's where they are after tomorrow's decision. Only a 2.7% chance they leave it unchanged. Obviously, that's the outlier. It would be a huge surprise, but that's the definition of surprise. Nobody's expecting it. I would be shocked if they did nothing. Be a huge volatility. Bond prices would get hit. Stock prices, at least initially, would really get hit. And you need to know that. But you also need to know how big of a surprise and outlier that is. 97% chance that they do a quarter. So that's what's baked in. All right. Now, the next meeting is in December, about 6 weeks out. What they say in the statement is going to start pricing in or out another quarter cut before the end of the year. So that's why the statement's important. Obviously, they cut a quarter. That's expected. There'll just be a little whipsaw. But the statement, the words, the phrases, the commentary that comes down at 1 o'clock Central is where we're going to get any kind of reaction to the up or downside, no matter what you trade. What would create an upside surprise? remember this word, dovish, and we should know this, right? Dovish means lower rates. Hawkish means what? Higher rates. Stock market wants dovish commentary to create upside. They want some indication that there weren't a lot of descending votes. If there's more descending votes than expected, that's hawkish. Dovish equals, I don't want to confuse you guys, but dovish means bullish. Hawkish means bearish. For the ES, let's just talk stocks now. Dovish means lower rates, bullish for the stock market. Hawkish means, hey, maybe not so low anymore. And that's bearish for stocks. They want to see low rates forever. So the probability of doing a quarter is pretty damn great, almost 100%. But the fact, what the commentary over here could be at the 1 o'clock central statement, it's a toss-up. I think they have a better chance of sounding hawkish and doing nothing on December or into the next meeting in December. There is some previews that come out that I use to really kind of wait to the last hour or two to make sure that the resources I use are up to speed with everything that they look at. Let's go back to this tool again. And if you scroll up, and these tabs are all the meetings that are scheduled all the way through next year. The December 11th meeting will show you that there's a 77% chance that they're at 150, 175 by the December meeting, and they keep it there. This will obviously change after the statement, press conference, and in subsequent days with stock market reaction. But right now, it's pretty solid that they're going to leave it. They're going to cut tomorrow and then leave it for the rest of the year. And then probably be really quiet in an election year, which they generally try to be. And next year is an election cycle and a presidential election year. So they'll might do one last cut, or they should do one last cut tomorrow and then be quiet for a while. I think that's where the statement will line up. So if they're overly hawkish, this is what's important. If this is what's expected, what's outside the circle of expectation? Well, the first thing is they do nothing. That's huge. That's obvious. The smaller things outside is being a little more hawkish than the market likes. That could be more dissenters that didn't even want this quarter cut at tomorrow's vote. It could be something that's just outright change in the language or a phrase that's inserted that says, hey, we're done for a while. I don't know what that phrase is. We're not in the business to predict exactly what the words are going to be. We get paid at reacting and understanding what those words mean. So if the words are something like, hey, we're done for a while through the end of next year, we're going to wait and see, I don't think the market's initially going to like that. What's really important, and the most important part of this preview, is that generally the opportunity in central bank decisions comes off a lead lag between stocks and bonds. Now, stocks and bonds move opposite, except when it comes to central bank policy. Then stocks and bonds move together in price. I'm not going to get into why. There's a lot of videos in this Edge course that talk about why. But when it's central bank policy move in price, they move together. So when the statement comes out, let's say stocks and bonds both go up. Stocks go up a little bit more. And then all of a sudden, boom, bonds get hit and hit hard. Generally, there's a little lag, and then the stocks come off. I don't care if you were to sell it and take a short opportunity from this reaction. I do care that you at least see it, because you don't want to stay long if you're long or get long up here when you see the bonds go up, 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 and then down a lot and get whacked. Everything moves faster when these statements come out. So to properly prepare for it, your mind has to move faster. Faster prices move, the faster your mind and reaction times have to be. And the more correlations help when it's more volatile. The more they decouple, lead, lag, and all the rest. So for a while after central bank statements are released, press conferences are had, stocks and bonds go in the same direction, and bonds a lot of times will lead the stock market. So make sure you keep that in mind. The other ancillary market to look at, if you don't have a dollar index because it's an ICE product, you can look at the euro, which is the 6E out of the CME. Now, when the euro, the 6E goes down, that means the dollar is going up. This euro is against the US dollar. So if the euro's down, that means the euro's going down, that means the dollar's strengthening. This is really important because the dollar, because it's the native currency of the central bank doing the talking tomorrow, will go up if it feels it's a hawkish statement. It'll go down if it feels it's a dovish statement. So to further confuse you, and this shouldn't confuse you, but just to stay with me, if you're watching a dollar versus the rest of the world, then you could play that. Dollar goes up, that means it's interpreting a hawkish statement. If it goes down against the pairs, major pairs, then it's interpreting it as a dovish statement. But if you don't have a dollar index in real time and you're relying on the euro, then it's just like the opposite. The euro goes down, that means the dollar's strong. What does it mean when the dollar's strong? They're interpreting it as a hawkish statement. If the euro goes up, that means the dollar's going down. They're interpreting it as a dovish statement. The native currency of the central bank that's doing the cutting or the hiking goes in the direction of the interest rates. I must say that dozens of times throughout this course and through all the videos you guys have access to. The native currency of the central bank doing the talking goes in the direction of interest rates or in the direction of the perception of interest rates. It's not what they do, it's what they lay out in what they want the market to bake in and telegraph. There could be some resistance 40, 41, like I said, right now. If you're watching this video in the future, obviously what I just said is not relevant, but right now we had that bearish comment that they might not have a signature at that APEC meeting. We slid down to 34. We come back to the scene of the crime. Could be some initial resistance. So going back to the Fed preview, native currency will follow the direction of rates or the perception. And the perception are the words dovish and hawkish. Dovish down, hawkish up. Dollar goes up, hawkish, down, dovish. Now, when it goes up a little bit, it's not, oh, they think it's hawkish. No, when they fly higher and fly lower, the faster and more a market moves that you're watching, the more important it is. What's important to grab your attention if you're watching over a crowd of people? Something that stands out, something that's moving around real quick, that's going to grab your attention. So the faster a market moves, the more likely it's going to affect, if it does affect your market. And that's when to really watch it. Correlations are about influence. The dollar get really strong and keeps rallying. That's not good for a stock market upside. It's not good for stock market upside on the heels of central bank statements. I'm not talking about 2 days. I'm talking about 2 minutes after the statement. So you're not going to use the dollar. Let's just talk about the euro. The euro gets killed and getting smoked and getting hit. That means the dollar's going up. That means it's interpreting it as hawkish. That means the stock market probably will struggle to go up. And the stock market, ES, NASDAQ could get weak. What will the bonds do? If the dollar is strong, let me put this out there for you guys. I won't mention you if you're right or wrong. If the stock, let's just go over something. If the dollar, US dollar is strong and starts rallying, the euro goes down, stock market goes down, what do bond prices do? Up or down? U for up, D for down. Just one guy knows the answer? If you don't answer, I'm going to assume you don't know the answer. No, Warren, not down, up. Just joking. Everybody got it right. Down. I wanted to scare you for a second. Yeah, bond prices would go down initially. Why? Because it's hawkish. Well, what does that mean? That means higher interest rates. Well, why do bond prices go down? Because bond prices go opposite in the interest rate that they are tracking. Interest rate goes down, bond prices have to go up to reflect it. Interest rates go up, bond prices have to go down to reflect it. So the key is that, markets always have things priced in. It's when things change that they have to reprice. So anytime you get a big move over a short period of time, it's the market pricing in something that changed. We call it repricing. That's when you get your trend day, and that's when you get your wider range days. You get volatility up, down, and every which way is when you're getting markets that keep getting hit with headlines back and forth and rumors and things like that. But what you get when you are repricing, it's like, oh, wait a second. Like the stock market repriced 100% chance pretty much of a quarter cut the last few sessions, Friday, yesterday, and today. Even though we went down on the U.S.-China news, we went back up. And now, let's take a look at this a second. Right, 40. I should have said 40, 41. I doubt it flies through 42. 41 is right where it was when this comment came out, just ahead of 11 o'clock Central. That's where it got cracked. So if I draw a line across, most likely there'll be resistance until it's not. This tells you something. You'll chop, at the very least, you'll chop around 41. If it can't go back down in a short period of time, then this market's strong. It's like a beach ball underwater. It can't go down on what's seemingly bad news. Now we've got something else to watch. This is a tweak and a bit of a game changer if indeed they don't have a signature at this APEC meeting. Because to me, it's like, well, same old BS. You either you have something or you don't. And if the market priced in that you have something and you don't, they're going to have to make adjustments. I'm going to stop the recording. That'll be the end for this session if you're watching on recording. And I want to add a couple things for those. In fact, I'll add it to recording for people that are watching. Either next Tuesday at 11 or next Wednesday at 11, which seems to be the times people like to watch webinars, we're going to have Ken Packard come and do, I think, what will be a really, really good webinar on psychology. I'll record it, but it'll be much better if you guys are here live. I'll send an email either way. Let's see what he said. I got to do a little sound check with him. It's going to be Tuesday, same time. So we don't have to change up the dates, and everybody's used to coming Tuesdays at 11. They're going to stay. It's going to stay next Tuesday at 11 o'clock. My answer to that, Bob, great question. I don't know. Other than it's a contract that's traded on the CME, Fed Fund Futures. I really couldn't give you any of the mathematical formulas of the correlationship that generates that graph to tell you 97%. Just like I couldn't tell you the yield of the 30-year bond based on its price. Figure it out, but you follow the Fed Fund Futures and know the direction is based on the probability of pricing in a cut or not. But I think the best reaction, quickest reaction is in the currency and the bond markets, knee jerk after a Fed statement and meeting. Good question, though. If I had a prize for a great question, you'd get it. Ken just replied to me, Tuesday 11 is good. It was going to be Wednesday 11. I said, well, why? Thinking, why should I change it up? Let's keep it on Tuesdays at 11. Everybody's used to coming to these meetings then. So even if you're watching this in the future, the next meeting that'll be uploaded in the recorded section, watch. It'll be on November 5th. But for you guys here live, do all that you can to be here live. Yeah, I'll try to record it, but you never know what happens with recordings. So far, I've never really had an issue, but I got to do a quick sound check with them. But everything should be good and work. So I want you guys to be careful for tomorrow. Follow your correlations. Know there's going to be a inflection of volatility at 1 o'clock and again at 1:30, right? Understand that. Don't let that catch you by surprise. Also, to prepare you for tomorrow and this week, and I mentioned this in the trading room, is that this week come in like a lamb and out like a lion. Tomorrow, not only do we have the Fed at 1 and 1:30 Central, we got Apple after the close to report earnings. And in the morning, before I even open up the trading room, we have ADP and GDP. ADP is a precursor to the non-farm payroll number on Friday. If it doesn't miss by a lot, it doesn't matter. GDP is the first look at the third quarter. If it misses by a lot, it matters. If it misses to the downside versus its estimate, the recession hawks will be back. And I think at 8:40 tomorrow, we will have Chicago purchasing, kind of a regional manufacturing look, which have been important. Friday, unemployment number comes out at 7:30 Central and 9 Central ISM. Generally, when the first Friday is the first day of the month, we don't have the unemployment report, but it is and it is. Very rare we have the unemployment number and ISM, two of the biggest numbers of the month, on the same day, but we do. 7:30 Central and 9 Central on Friday. I was open the room early at 7:15, and I will on Friday. So don't forget all those things, what I just told you. ADP, GDP, Chicago, FOMC, Apple, impeachment vote on Thursday, unemployment and ISM on Friday, and now this new speculation that they might not sign phase one in Chile created that move lower, and now they're trying to use 41.42 as overhead resistance. We'll see you guys next week or tomorrow in the trading room.